Hi there, I'm Flipito. It's July 13th. We are live, and that inflation that everyone keeps telling us not to worry about is proving slightly more explosive than we had all hoped. Today, we are live with the man who, for the second month in a row, saw the upside inflation surprise coming. If you were paying attention, he just made you a pile of money on Polymarkets. So what does he see coming next? Let's find out. Hi, folks. Welcome back to Polymarket Insiders, your source for real-time coverage of the global information markets platform, Polymarkets. And this morning's inflation numbers from the BLS, Bureau of Labor Statistics, I really can't overstate how hot it was compared to expectations, but also just in terms of the absolute number. This month-over-month inflation number was the biggest since the financial crisis of 2008. So let's get right to our guest today, making his encore performance on Polymarket Insiders. It is Chris Brunet. You may know him from Twitter or Polymarket community as Exogeny Carl. Welcome back, Carl/Chris. How are you?
I'm pretty good. The numbers, as you said, they were just released like a few hours ago. So the world is still reacting in real time to just how large they were. And this is like me reacting in real time, basically.
Indeed, yeah. So just set the stage for us. What was the expectation? What was the relevant Polymarket market trading at, and where did the number actually come in this morning at 9 o'clock?
So economists were expecting roughly 0.5. That's month over month core inflation from last month. And the Polymarket threshold to beat was 0.6. Actually, to be more specific, the threshold was 0.55 since BLS rounds up. So inflation just had to be greater than 0.55, and then it would be greater than 6, and then it would be yes. Outcome would be in the money. And then so yeah, after 0.5, 0.6 comes 0.9. 0.9 is where the number actually came in at. So that was above everyone's expectations. I had really high expectations. I had higher expectations than almost anybody. Even like if you look at the crowdsourced Bloomberg economists, they have like 50 or 60 economists crowdsourced their predictions. I was in like the 90 percentile, something like that. And it like blew past my expectations. So like for the past 2 or 3 or 4 months, inflation has almost always been off the charts for expectations. And I think that's really leading the market to unmoor their expectations. Expectations are starting to price in more inflation in the future.
Yeah, it certainly sounds like it. And that 0.9%, as I said, that's a month over month rate. And, it's really sort of suggesting that this narrative that, price inflation is broad-based as it's been. And obviously people are starting to actually feel it, in their pocketbook, whether, buying used cars at the pump, buying groceries. We've been told that it's really quite transitory, that it's really going to scale back. It's to do with reopening and certain supply chain dislocations, which certainly it is. I mean, it not to opine on whether it's necessarily transitory, but or fleeting, but it certainly is to do with post-pandemic and reopening pressures. But that doesn't mean that it's transitory, right? You can have inflation, you can have a wage price spiral that can be sparked by any number of macroeconomic shocks, and obviously this is about the most shocking of shocks in terms of macro impact. So, from your economist perspective, if we leave aside the markets, the market impact and how we might be able to profit off of this insight for a moment, and just think about the macro impact, does this worry you that what was seen as transitory might stick around, might be a more kind of intractable inflation problem for us to deal with? And how does that impact broader markets, economic recovery, stimulus plans, things like that? Is this something to worry about, or is this number as big as it was, a bump in the road rather than a sort of a directional shift in the trajectory of the recovery?
Sure. So short-term inflation, first of all, is can be influenced by all these factors that you mentioned, such as oil price or supply chain disruptions. But long-term inflation is really tied to consumer expectations, and consumer expectations are at, I believe, like if you look at surveys of consumer expectations and corporate expectations of inflation, they're all at record highs for like 10, 20, 30, 40 years. And as to whether or not I think it's around, the answer, uh, frankly, is yes. From a really, really high level perspective, this is really my thesis is they printed too much money and now the money is being devalued. You can like point to all these factors and all these little excuses, but at the end of the day, inflation is everywhere, and always a monetary phenomenon.
Yeah, and surely from monetary policy to fiscal policy, we have seen just about as loose, in other words, as sort of pedal flooring policy stance, possibly as we've ever seen, certainly in recent memory, from the federal government, and eventually, whatever temporary dislocations you have in terms of supply chain and reopening pressures, you flood the market with that much, that many more dollars, you wouldn't be surprised to see prices sustainably increase, and for price increases, in fact, to accelerate. So, with that sort of unpleasant context for examining the markets in a little bit more detail. Again, this was the second of two consecutive monthly Polymarket markets on the CPI, Consumer Price Index inflation, that you have opined specifically on. Last month, the June expiring, but the May measured month over month inflation. There, if memory serves, the strike level was 0.4, whether it would be 0.4 or higher. You pegged it exactly at 0.6 a month ago, made people a tidy profit of, I think, about 50% from the closing or just prior to closing price. I think it was trading at about 70% to eclipse 0.4, and it obviously easily did. This time, though, the returns from traders who followed your advice really blew that out of the water, right? Because people, higher strike here, 0.6, it would require inflation to actually, if it's accelerated from its already somewhat elevated pace last month, back to its recent high from, I think, April, where it also hit 0.6. And the market, by and large, did not think that was going to happen. So they didn't write off the possibility, but this was trading nowhere near 70, right? This was below 50 before the print came out this morning. Is that right? Here we're looking this
Yeah,
market, that's actually from the month ago one. So if you see that on screen, April to May, that's the previous one. But from this morning, I think it was, here we are. There's the blue line is the one that settled in the money. That's, yes, it would be more than 0.6, and it looks to me like that's about 35 cents as of yesterday.
yeah. So as you were saying, the one 2 months ago was, I considered it a slam dunk simply because the threshold to pass was 0.4, was so low. And now the threshold month was zero point 0.6, so I was still a little bit less certain because zero point 0.6, if you annualize that, it's like something like 8% inflation. I don't know, that's off the top of my head. So zero point 0.6 is still really, really high. It was a high bar to clear. And the fact that it came in at zero point 0.9, if you annualize zero point 0.9, that's something like 10 or 11% inflation a year, which is just off the charts. And if you listen to what the White House is telling you, the White House is still saying, "Oh, don't worry, it's still going to be 2 or 3% this year." But if you listen to what, for example, General Mills or Costco is saying, these are the people who really know the food price. Jen Psaki, she does not know the food prices. But Costco and General Mills, they're saying 7 or 8% inflation this year, and I trust them more. Larry Summers, everyone knows Larry Summers probably. He's saying 5 or 6% inflation. I think that's also on target. Yeah, in terms of how much money you would have made betting on this market this month, I invested something only like $250, and then I made a profit of something like $500. So I woke up this morning and I checked my phone and I was happy. um, Now, yeah, yeah, there you go.
So I want to talk a bit about looking forward to next month because I gather we're about to get the replacement market on Polymarket. So I want to talk about that and possibly give traders a little bit of jump in their handicapping of the next print in this series. But just looking back again, so you had a nice score a month ago, a huge score, basically nearly tripled up this morning from the last night price. But give us a little bit of a better insight. You talked a bit about, whose read of the inflationary pressures, whether the White House, the administration, or the sort of big global supply chain retailers and wholesalers. What other analysis did you do, though? I know you wrote a couple of lengthy Substack articles about this, but what was sort of the signal that you were teasing out that gave you confidence that last month was a slam dunk and that this month was so underpriced, despite the market really seeing that they would not hit that 0.6 threshold? So what lesson can traders glean from this in terms of what was the true signal that you were latching onto that enabled you to be right twice in a row here?
So I'm going to give you a short answer and I'm going to give you a long answer. The short answer is don't trust the White House. Don't trust the Council of Economic Advisors in particular. That's the hyper-partisan council of economists that advises the White House. And it's led by people like Jared Bernstein, who's not even an economist, by the way. He's a social worker. And it's led by people who, like Heather Boushey, who is like a far left ideologue who works at think tanks. These are not trustworthy economists. I value their words at less than nothing. Same with the bond market, really. The bond market, in my last blog post, I talk about the bond market being mispriced. And basically that's because the bond lags real inflation. But my take on this, which I didn't write, my take is that the bond market is essentially rigged by the Fed and the Fed's friends. They're printing something like $130 billion per month right now and handing it out just to BlackRock, essentially. And BlackRock is setting the bond market at whatever they want it to be. And in my opinion, they're setting the bond market so as to not scare people about inflation, but people have seen past that. People have seen inflation, and now the bond market is going to adjust. And if I were a hedge fund manager, if I had millions or billions of dollars right now, I would be totally betting on the bond market being mispriced. I haven't checked this morning after the news came out, but I'd be willing to bet the bond market moved big. And if it didn't, then that's even more opportunity as a hedge fund manager. One more thing that I wanted to mention actually was, I said don't trust the White House. And I've been tracking for inflation right now for about 6 months, like really vigilantly. And in that time, the narrative from the White House has really dramatically shifted. The goalposts are constantly being pushed back. So 6 months ago, if you even brought up the possibility of inflation, they told you to shut up. They told you, shut up, right-wing conspiracy theorists, let us print these trillions of dollars. Just let us print this money, it'll be fine. Then a month or two ago, it was, it's transitory, don't worry, it'll go away, don't worry, it's transitory, bro. Now that like the past 2 or 3 or 4 months have been steadily really high, it's, inflation is good. Inflation could be a good thing because you can inflate away our debt. Or it's good because it's a sign of how hot our economy is. It's a booming economy. And frankly, that's just a total joke. I mentioned Heather Boushey before. She's on the Council of Economic Advisors. She's the one saying this. She came out this morning after the high numbers, and she said, don't worry, it's just cars. It's just used cars. And, well, first of all, I don't buy that at all. This easy answer is because used cars only account for 1% of the CPI basket, and so the used cars talking point makes no sense to me, really. The Biden administration.
Yeah, and sorry to interrupt, but it's worth putting some numbers around that. I think U.S. cars were up month over month. It's truly staggering figure, something like 10.5%. But as you say, it's an only 1%, roughly 1% component of the overall CPI number. So that added what 0.1 percent. Just back of the envelope, 1/100th of 10 percentage points would be 1/10 of a percentage point. So even if you want to wipe that out and say the used cars, you can take an ex-used cars number, that gets you down to 0.8%. Still way above trend, way above consensus, and a really worrisome number. So yeah, the used cars were part of it, but that doesn't explain away. That's not enough to say, hey, don't worry about it. It's just used cars.
Yeah, and if you look on Twitter this morning, they're making all these beautiful graphs showing how used cars are the biggest chunk of inflation, but those are totally manipulated to get the answer that they want. The Biden administration, they're saying, oh, it's just used cars. Oh, it's just oil. Oh, it's just chicken. Oh, it's just housing. Sure, as long as you don't need cars, housing, food, or energy, there's no inflation. But
Right.
and if we take out the price of those that rose this month, there's no inflation. It's really Mickey Mouse tier on.
Chris, we may have lost you there for a second. Let's give you a moment to see if your feed comes back in. But just going off that point, I mean, it's well taken, at least by yours truly, that if you can X out enough things, you can get to a slightly less worrisome number. But again, as we're trying to think about what this means for the future trend here too, because that obviously is a little more important than just the month over month number. If you have major input prices, energy prices, crude oil prices, wage prices, which again are suffering from, or their unnatural upward spiral is suffering from very obviously very artificial input or price control on the price of labor, given the extended and now increasingly controversial work disincentives. The response to which is always, well, just pay more. Hey, you employer, if you don't like the fact that you can't find anyone to work for what you're offering because there's such a compelling stay-at-home option, pay more. Beautiful win-win for everyone. In fact, that's how CNBC phrased it a few days ago. Is, inflation, this is actually kind of a win-win. You're worried about paying more, but you don't think about the fact that your wages might be going up. Similarly to employers, hey, you're worried that your wages are going up, but hey, you get to sell stuff for more. That's not a win-win. That's the wage price spiral. That's everything going up. And again, as we're trying to get a handle on what this means going forward, is this the start of kind of an inflection point of prices sustainably increasing at a swifter rate? Then that's, from a broad economic perspective, kind of a bad thing. But again, as we get back to how do we profit from this, whether in information markets, prediction markets, or traditional financial markets, Chris mentioned one way to play this potentially in the bond market, and he was saying he had looked at the bond market reaction today, and just looking here across the complex, looks like broadly things are up kind of 2, 3, 4, even 5 points in terms of the yield, which is to say the prices have come down something like 6. Maybe 5-6%. So when he was saying that he would suspect the bond market is still mispriced, one presumes that he would mean that he thinks bonds would still be overpriced, in that if inflation is going to be a more intractable problem than the market and economists and the administration have yet acknowledged, then you will see interest rates going up more sharply and sooner than people expect, which of course will bring down the price of bonds as their yields have to increase to match that. Hey, we've got Chris, you're back with us. Yep, you go ahead. I was just talking about sort of the longer term implications of this. If you need to X out everything to get to an inflation number that's less scary, that may in fact mean that we're going to have more rapidly rising prices in coming months and years, and that there may be a policy impact there that could mean that the bond market is, as you said, overvalued, but also possibly that contracts on markets like Polymarket are mispriced. So I'm not sure how long you're in the dark there, but anything from that you want to dovetail off of in terms of the economic impact, the financial market impact, or sort of how we should be thinking about making our own forecasts and playing them in platforms like Polymarket.
I'm so sorry about this. I can respond to questions that are typed in the chat, but I cannot currently hear anything.
Oh, sorry about that. Why don't
the last I remember, I was ranting about inflation.
Okay, I'm going to go ahead and type as I talk here into the chat. What do you see as the longer term macro impact and policy response from the admin if the thesis that inflation is higher than expected is correct? All right, give Chris a chance to read that and respond. Also take this moment to remind you at home, if you have a question, go ahead and submit that into the chat as well. We'll see if we can answer any questions in real time on air here. So we've got my question to Chris up on the screen. See if you can see
What do you
that.
see as the longer-term macro impact and poly response from the admin if the thesis that inflation is higher than expected is correct? Okay, great. I can actually answer this question. So here's what I expect to see from the Fed. When I hung up, I was talking about how I don't trust the White House, but I do trust the Federal Reserve still being credible. So that's why I wrote my Substack article this month. I put so much emphasis on parsing their little hints that they were dropping, and I was interpreting their tea leaves that they were laying out for us. And so this month, I'm going to be hanging on every word that comes out of their mouth. I'm sure they're meeting right now, like today, to best determine what to say this month and what to choreograph their actions for next month. And so here is what I think they're going to do this month. What they're not going to do is say, oh, we're going to raise rates. What they are going to do is they're going to aggressively hint that they're going to start tapering, okay? And so that last month, they did a couple little coy hints that, oh, like maybe it's time to taper sooner rather than later. But this month, what I believe they're going to do is they're going to say, oh, look, we're going to start tapering soon. Get ready for it. And now in a month or two from now, they're actually going to start implementing that tapering, maybe if inflation stays high. Here is the thing, though. The longer the Fed waits to taper its asset purchases, the harder it gets to taper. That's because the longer the Fed waits, the larger the balance sheet grows, the higher the national debt rises. The larger the debt, the more the Treasury depends on the Fed to finance it. Put simply, I don't think the Fed has the political will. I don't think they have the courage. I don't think they have the balls to take any substantive action to really put inflation back in the bottle. The genie's out of the bottle, and I think we're more or less doomed to just sit back and watch inflation spiral out of control for the next year or two. I'm going to keep talking because I have some more stuff to say about this. So when Powell, a lot of people say Powell is going to stop inflation because, oh, he was so brave how he acted on COVID. He took such drastic measures. He thought outside of the box. He acted so hugely and so passionately. But at the end of the day, what he was doing is he was printing other people's money, and everyone loved him for it. It's really easy to helicopter drop money and take all the glory for it, but I just don't think he has the will. I don't think he has the stomach. I don't think he has the political capital to do it, even if he wanted to. Because the U.S. GDP right now is at 130% or something silly like that. Even if the Fed wanted to raise interest rates by 1 or 2 or 3%, that would be like the first step to rein in inflation. But they're not even going to get close to doing that. What they're going to do is they're going to keep bumping it up, like maybe by 0.25% over the next year or two, if we're lucky. And that's frankly acting too late. He's totally handcuffed because if he raises the interest rate, then the debt servicing that the U.S. is paying on that debt that they have right now, it's just going to be totally unsustainable.
Yeah. And this is really the reason why you don't let the inflation genie out of the bottle in the first place, is that it's so hard to put back in, and why if you sort of ignore the earliest indications, those first few canaries to die in the coal mine, then by the time you're forced to acknowledge what's really going on, you've really got a huge intractable mess on your hands. Chris, I don't know if you can hear me again. If you can, let me know. If not, I'm going to type one more question for you into the chat. Are you reading me yet? Not yet. All right. I'm going to type another question to you here in the chat box that says, what would be a fair price for a Polymarket July inflation market? That would be one expiring a month from now with a 0.7% threshold. We don't have that market yet, but let's assume it comes in at 0.7. Where would you price that kind of a market?
What would be a fair price for the Polymarket July inflation market with a 0.7 threshold? Okay, so I know nobody likes economists because they never give you a straight, easy answer. But the real difficult answer is it depends how the month plays out, right? Like the month just started, and we're gonna have to see. Like I'm gonna be watching intently to see what the Fed says over the next few weeks and what the price of X, Y, Z does over the next few weeks. Um, but what would I think a fair price for the Polymarket July inflation market be? I would say greater than 60% chance it's over 0.7. I think now that inflation's out of the bottle, um, it's just gonna keep being high right now. Even if it drops by two. Okay, so if you look at the time series of CPI, it usually never drops or increases by more than 2 or 3 per month. So it would need a pretty big drop to get below 7. It would need to drop by 0.3, which is what it increased by this year. And that was like a huge unexpected rise, right? So I would think there's a better chance than not that it's above 0.7 next month. And I think it's going to be priced well below that simply because people are still holding on to hope that inflation will be transitory. And looking long term, because Polymarket is going to be doing these markets probably every month moving forward. I hope. Moving long term, what I really think for the long term is so when you read articles, when you read chatter, I'm going to call it chatter from people in the industry right now. There's a lot of talk about shipping rates. Okay, shipping rates are skyrocketing right now, going out of control, mostly because there's a lot of money sloshing around in the world and there's not that many goods. So when the Fed is printing money, they can print money easily, but they can't print goods. And so, yeah, the chart right there kind of tells the whole tale. When you listen to chatter from retailers, like if you even like big box retailers like Walmart, like and more importantly, not Walmart, but the bankers who cover Walmart. This is what they're saying. They're saying that get ready to pay higher prices for your Christmas shopping. That's the line right now due to consumer shipping rates. Do you think it would be good several inflation markets on Polymarket, for example, with 0.7, 0.911 thresholds? I think that would be an interesting idea. I don't think there's enough liquidity right there right now to deal with it. Right now, inflation is one of the lesser popular markets on Polymarket. It seems to be ramping up every month, and as as people start seeing that we're in a new structural regime of higher inflation, I think the Polymarket liquidity for the inflation market is going to double, triple, quadruple. I think it's really going to be a bigger market once inflation is on the headlines every single day, right? And it's going to be like a really hot button issue over the next year, or at least that's what I think it will happen. And my yeah.
Yeah.
So I think it would be a good idea to have those markets, but only once there's more liquidity.
Right. Yeah, I think that makes a lot of sense. And I think your read on where the liquidity might go from here is about right, too, because inflation is going to become more of a headline issue, something that the general political body is going to be aware of and have an opinion on. And when people have an opinion on, they're usually willing to put their money where their mouth is on such things, for better or for worse. And certainly with astute analyses like yours, not only on air, but on your Substack, on Twitter, gives people a little bit more of a foundation upon which they can trade in an informed basis and hopefully in a profitable basis. So I wouldn't be surprised to see the liquidity on this series of markets continue to increase, and I certainly would encourage all of our viewers to follow Chris's analysis. Again, on Twitter, he is Exogeny Carl, which you can see under his name there, and on Substack, he is Carl Stack, Carl with a K, stack.substack.com. So, Carl, I don't know if you can hear me again yet. If so, I want to thank you for joining us on my own behalf and that of the viewers. I want to thank you, viewers, for joining us. Again, feel free to follow us, connect with us on Twitter, where we are Old Bull TV, and our DMs are open. Thanks again for joining. Happy trading, and we will see you next time.